flowing out of the country. In other words, if all these products are flowing out of Japan, then what's flowing back in, right? Capital is flowing back in, okay? And again, capital flows can make an economy stronger. They can strengthen a currency. So there is an inherent demand for the yen because of their trade surplus. However, if you've ever wondered why Japan is able to sell products that are high quality but inexpensive, one of the ways that they're able to go about that, obviously they're very efficient and they have products that are of tremendous quality. Another way that they're able to keep those prices low, however, is through intervention. There's a lot of pressure in Japan to keep the yen weak. The exporters, the companies that are exporting these goods, want to see the yen kept weak. Why? Because it makes the products more affordable to people in other countries, the importers. It makes the products much more affordable. This is what the economy is based on. It's an export-based economy. So that's why you're going to see that monetary policy from the Bank of Japan, very key. And we do see some intervention there from time to time, and it can be an interesting situation. Let's talk a little bit more about intervention, shall we? Intervention, again, a central bank is attempting to force the exchange rates to favorable levels, favorable for them, obviously. Now, the Bank of Japan occasionally intervenes on behalf of the yen, as we've discussed, and through intervention, the Bank of Japan is able to keep exports at reasonable prices. And now, some countries are going to use intervention to prevent excessive market movement because it can be difficult to do business with other countries, of course, if your exchange rate is very volatile. That can cause problems. So some countries will step in just to try to provide stability. We talked a little bit about jawboning earlier, and the mere mention of intervention can cause markets to fluctuate. So we try to monitor comments from the Bank of Japan, the Ministry of Finance, to see what their thoughts are regarding the FX markets. It can be very important. Central banks often signal their intentions well in advance. And again, this goes back to jawboning. Essentially, they often let the market know what their intentions are in the hope that just by revealing those intentions, that the prices will move, the exchange rates will move to levels that they find sufficient. Again, they're hoping to move the market without actually intervening in the market itself. We're taking a look here. I'd like you to take a look at this chart. This occurred in, first of all, late in the year 2000 and early 2000, late in 2003 and early 2004. We're looking at a chart of the US dollar and the Japanese yen. And what you'll see is there's a very strong downtrend here in 2003. Now, in order for the dollar-yen pair to be trending lower, what must be happening? The first member of the pair, the US dollar, is weakening against the second member of the pair, the Japanese yen. If the dollar were strengthening against the yen, this pair would be rising on your chart. Instead, it's falling. And we see that it continues to fall throughout 2003. But in early 2004, the Bank of Japan steps in. And again, they signal their intentions well in advance. And you can see how they move the market here, really causing a sharp increase in the exchange rate of dollar-yen. And of course, whenever this exchange rate rises, Japanese products are becoming less expensive to people in the United States. Whenever this exchange rate falls, Japanese products are becoming more expensive to people in the United States. So that's a brief look at intervention. And, I just wanted to cover a brief history of the FX market now. We're going to take a look at some of the events that shaped the market and led us to where we are today in the FX market. First of all, the Bretton Woods Agreement. Now, this is going to happen in the 1940s. Post-World War II, the economies of Europe were devastated, obviously, and looking for stability. And what occurred is many of these nations, 44 different countries, met in Bretton Woods, which is in the United States, and agreed on a method of valuation where different currencies would be fixed to the US dollar. In other words, they would not fluctuate. They would be pegged, as we say. Exchange rate would be fixed between these currencies and the US dollar. The US dollar at the same time would be pegged or fixed to the price of gold at a particular level. And of course, the idea was to create stability in the markets because there was so much turmoil in the economic world at that time. But unfortunately, what this system does, it essentially ignores the reality of the situation that some currencies, let's say some economies, are stronger than others. And it's not being reflected in the currency because the currencies are trading at fixed rates. So the system began to show some cracks. There were some major devaluations of currency. And this is where all the speculation would surround these devaluations, because we would get to a point where it would be obvious that a certain currency would have to be devalued or revalued. And because these cracks began to appear, in the early 1970s, the Smithsonian Agreement was enacted. And the Smithsonian Agreement was, it took the Bretton Woods Agreement and it tried to give it a little bit of leeway. It gave it a little bit of room to work with. So it widened the band in which currencies could fluctuate. And this was an improvement, but the same, the same problems began to creep up, and the Smithsonian Agreement also, turned out not to be sufficient to the FX markets. What happened was there was a major devaluation, there was some chaos in the currency markets, and trading even stopped for a brief time. And what happened when trading resumed, the major currencies were floating freely against each other and against the US dollar, and it was supposed to be a temporary arrangement, but that arrangement continues to this day. It turns out that obviously, it's obviously a much more free market in this manner, and it's a much more tradable market. So what happens is, as time progresses, volume began to build because it became a market that was good for speculation. Volume grew, and then as the 1990s approached, technology began to grow, making the market more efficient. Not only making the market more efficient, but making it available to individual investors like you and me. So what was once the playground of the hedge funds, the major multinational corporations, now individual investors can now get involved in the Forex market. So that's where we stand today. That's how we've evolved. And so I'd like to wrap it up now, but before I go, I just want to mention the FX Power course to you. Again, at FXCM, we do instruct trading. We give one-on-one lessons. Again, my name's Ed Ponzi. I'm the Chief Trading Instructor. I do give one-on-one lessons. In addition to that, we have online trading classes that are available. If you'd like more information, please feel free to go to www.fxpowercourse.com or go to www.fxcm.com and click on Trading Courses. You can also give us a call over at FXCM anytime. We're literally available 24 hours a day, 7 days a week. Happy to answer any questions you might have about this market. I hope we've been able to demystify it for you a bit, and we certainly hope that we'll be hearing from you. I just want to say thank you for inviting us into your home today. I hope that you'll be able to take advantage of this market, and we hope that you enjoyed the presentation. Thank you very much, and have a great day. Hi. In appreciation for your participation in this course, FXCM would like to offer a $100 rebate to any trader who opens an account with a minimum balance of $5,000. To take advantage of this offer, please go to www.fxcm.com/pristine.html. Thank you very much.